The Labor Department released data Tuesday showing wages are up slightly when accounting for inflation. Real average hourly earnings increased 1.2% from June 2022 to June 2023, the largest 12-month percent gain since March of 2021. Meanwhile, the Federal Reserve Bank of New York reports that rejection rates are up for many loans, including mortgages, auto loans, and credit cards. Here to help us make sense of the lending landscape is John Vivian. He's a senior director of Potomac Global Partners, a finance consulting firm. So why are more Americans being rejected for loans?
So great question. And I think you can really trace it back to three key factors, most of which the American public knows and understands. Number one, inflation. Number two, higher interest rates. And number three, and you touched on this with your data set that you just presented, lower or negative real wages. And the pressure from those impacts on the consumer are significant. Now, your question about why are banks rejecting credit applications? Well, because of those areas. But if you understand how a bank underwrites all of their loans, it's based on a cash flow basis. So they're analyzing loans, they're analyzing the borrower's capability to repay their debt. And when those pressures are there, whether it's inflation and buying the things that they've typically purchased, whether it's higher interest rates, or whether their real income has declined here until recently, that's been the case with the high inflation, then banks will not, then those borrowers will not meet the credit standards of their policies.
What's your feeling then about if some of those things might change, if real wages do improve, if inflation's coming down, and then, of course, the Fed plays a role? Do you think that this rejection of loans continues, or the banks might loosen up a little bit?
Well, again, it really comes down to the cash flow then. So as real wages increase, clearly then the consumer is strengthened and their capability of repayment is stronger. And, and then the bank's decisions on what their credit policies will be driven by the cash flow situation of those borrowers. So your question, will the banks loosen up? It depends on the broader environment that the consumer is really in. Depending on where you're at on your income strata, whether you're a lower income, middle income, or higher income person, those decisions may vary, and the credit denial rates may vary as well.
And how are banks doing these days, by the way? I mean, we've, obviously there was a great deal of turmoil in the banks several months ago. What is the cash flow as a part of that, just in terms of risk tolerance and a sense of how jittery things are going to be in the future? Is it possible to give us a sense of what the banks are looking like at this point?
Sure. It's a very timely question on your part. We're right in the middle of large bank earnings season. And if you look at the banks that have reported up till today, over the last week and a half, I believe almost everybody has exceeded the expectations from the street as far as where they expected to be from an earnings standpoint. Now, as part of that earnings stream, back to the credit denial rates and whatnot, the big variable there is can the consumer continue to make payments on growing credit card balances, and how much in reserves will banks have to sock away for future loan losses, which will be the ultimate determining factor. And again, in many banks that do credit card lending, many banks do auto lending, many do all of those things. And so how they will perform in the future is yet to be determined, and a lot by the economic factors that we're looking at.
And I want to throw one more figure at you, John, and I appreciate you fielding all of these, but what J.P. Morgan Chase has data showing that account balances are up about 10 to 15% for folks compared to 2019. Now, as I think I recall, that's up relative to 2019, but they were even higher during the pandemic. People didn't have a lot of money to spend on things. They were getting cash transfers. So how does that figure mesh with what you've been saying in terms of the environment that banks are looking at?
Well, I guess I would characterize. I saw that Washington Post article, and I would characterize it as being a very narrow or flawed assessment. Looking at one point in time, versus back in 2019 versus now, very very different than if you look at things from say a year and a half ago till now. And you look at what's transpired since then. Bank balance or balances on hand at banks, their consumer balances have declined dramatically. At the same time, over those 18 months or so, at the same time that the Fed has risen rates. So credit card balances have increased 17%, the largest year over year jump in the history of the Fed's 20-year data. And so the cash balances have run down at a time when interest rates have risen because of the Fed and their decisions, and that's straining their cash flow. So yes, point over point, yes, you can make that statement, but a real analysis would say no, the consumer is not better off.
All right. John, Vivian, thank you so much for being with us.
My pleasure. Thanks for having me.